Dividend Aristocrats to buy and hold forever. Welcome to PyUncut, your weekly investing podcast where we turn complex market chatter into simple, actionable insights. In today's episode, we're talking about something that never goes out of style. Dividends. When markets swing up and down like a roller coaster, it's easy to get caught in the hype, chasing AI stocks, meme rallies, or the latest IPO buzz. But while traders chase headlines, true wealth builders quietly collect their checks, quarter after quarter. In this episode, we'll unpack why dividends are the new alpha in a volatile market, the top 3 dividend aristocrats to buy and hold forever, a couple of hidden gems with rising payouts, and how reinvested dividends can quietly outperform everything else over time. Let's dive in. Part 1. What makes a dividend aristocrat? So first, what exactly is a dividend aristocrat? It's an elite group of S&P 500 companies that have increased their dividends for at least 25 consecutive years. Think about that. Through recessions, pandemics, inflation spikes, and tech bubbles, these firms kept raising what they pay to shareholders. That kind of consistency signals 2 things. 1, strong cash flows, meaning the company can afford to keep paying out. And 2, shareholder discipline, a management culture that prioritizes rewarding investors. In other words, these companies are built to survive. And in times like today, when markets are uncertain, rates are sticky, and growth is slowing, that kind of resilience is priceless. Part 2, the steady pace set. Top 3 dividend aristocrats. Let's start with the blue chip trio that have stood the test of time. Johnson & Johnson, dividend yield, approximately 3%, dividend growth, 61 consecutive years. Johnson & Johnson isn't just a healthcare giant, it's practically a dividend institution. Even with litigation headlines and a slower growth rate, J&J has what few companies do: diversification across pharmaceuticals, medtech, and consumer health. Its free cash flow consistently exceeds $18 billion annually. That's what fuels the dividend engine. And because healthcare demand doesn't vanish in downturns, J&J's payouts remain rock solid. For long-term investors, it's the kind of stock you hold, forget, and wake up 10 years later with your yield on cost quietly doubling. Procter & Gamble. Dividend yield, approximately 2.5%. Dividend growth, 68 consecutive years. From Tide to Gillette to Pampers, P&G has built a fortress of everyday brands. It's not flashy, but it's incredibly consistent. Why does this matter? Because in inflationary times, companies like P&G can pass on higher costs to consumers, and people still buy soap and shampoo. That pricing power keeps profits stable. And when you look at total return, including dividends, P&G has outperformed many growth darlings over multi-decade horizons. It's the textbook definition of a sleep well at night stock. PepsiCo. Dividend yield, approximately 3.2%. Dividend growth, 52 consecutive years. Pepsi is more than soda. It's a snack empire. Doritos, Lay's, Gatorade, Quaker Oats, they all print steady cash flow. Even when soda consumption declines, Pepsi's diversified product line keeps it growing. The company has also mastered the art of slow and steady dividend raises, around 5 to 7% annually. So while the market debates whether AI or EVs are the future, Pepsi keeps paying you, rain or shine. Part 3. The hidden gems. Rising dividend stars. Not all dividend powerhouses are household names yet. Here are 2 under-the-radar dividend players that could join the aristocrat ranks someday. NextEra Energy. Dividend yield, approximately 3.4%. Dividend growth, 27 consecutive years. NextEra is a fascinating story. It's one of the largest renewable energy companies in the world, yet still runs a stable, regulated utility business. That combination gives it both stability and growth. While utility stocks took a hit as interest rates rose, NextEra's long-term potential in clean energy remains enormous. It's targeting 6 to 8% annual dividend growth through the rest of the decade, powered by expanding solar and wind capacity. If you believe in the energy transition, this is your dividend growth play. And Realty income. Dividend yield approximately 6%, known as the monthly dividend company. Realty Income isn't just a REIT. It's a cult favorite among income investors. It owns over 15,000 commercial properties across the US and UK, leased to big names like Walgreens, FedEx, and Dollar General. Here's the kicker. It pays dividends every month, not quarterly. And it has raised that dividend more than 120 times since its IPO. Realty Income gives investors a steady stream of passive cash flow, ideal for retirees or anyone building a compounding dividend portfolio. Part 4. The magic of reinvested dividends. Now let's talk about something most investors overlook, dividend reinvestment. It sounds boring, but it's the silent force behind long-term wealth. When you reinvest dividends, instead of taking them as cash, you buy more shares. Those new shares earn more dividends, and the cycle compounds. Over decades, this effect becomes staggering. Example, if you had invested $10,000 in the S&P 500 in 1990, your money would be worth around $135,000 today. But if you had reinvested all dividends, it would be over $250,000. That's the power of compounding income. And Dividend Aristocrats excel here because they don't just pay, they raise what they pay. That's an inflation hedge built right into your portfolio. Part 5. The ETF route. Simplicity with scale. If you don't want to pick individual stocks, there's an easy way to get exposure to Dividend Aristocrats. Through ETFs. SCHD, Schwab US Dividend Equity ETF. Expense ratio, 0.06%. Dividend yield, approximately 3.6%. Focuses on quality, consistent dividend payers. SCHD has become a favorite among income investors. It screens for strong free cash flow, high return on equity, and sustainable dividend growth. It's basically a set and forget dividend machine. VIG, Vanguard Dividend Appreciation ETF. Expense ratio, 0.06%. Dividend yield, approximately 2%. Tracks companies with a 10-year history of increasing dividends. VIG tilts towards dividend growth rather than high yield, so you'll see names like Microsoft, Visa, and Johnson & Johnson in there, blending income with long-term capital appreciation. For investors who prefer simplicity, these ETFs provide automatic diversification and discipline. No stock picking required. Closing thoughts. In a market chasing trends, dividends are the ultimate act of patience and conviction. They don't promise overnight riches. They promise reliability, and over decades, reliability wins. The Dividend Aristocrats, Johnson & Johnson, Procter & Gamble, and PepsiCo, show what steady payouts and strong balance sheets can do. The hidden gems, NextEra Energy and Realty Income, add a touch of modern growth and monthly consistency. And the ETFs like SCHD and VIG make it effortless to tap into that strategy. Remember, you don't need to time the market if your portfolio pays you while you wait. So, the next time the market swings or headlines screen volatility, take a deep breath and check your dividend deposits. That's real, tangible return. The kind that compounds quietly and builds wealth that lasts a lifetime. You've been listening to PyUncut, where patience meets profit. Don't forget to follow, share, and check out our visual charts and infographics on PyUncut.com.